Right, and we're just going to attempt the question number 42 uh, under the topic of IFRS 5, non-current asset held for sale and discontinued operations, right? This is the second questions on this topic, right? So I'm just going to straight jump into the question requirement, which is relevant, related to the standard that we are just covering, right? So I'm not going to do the other part of the questions. This video is only for the IFRS 5. So we've been asked, a requirement is that we've been asked to discuss with the reference to IFRS accounting standards and exhibit 1, right? So the part 1, the part A is required to, we just need to, they haven't explicitly or expressly mentioned about which standards need to be applied, but we know clearly exhibit 1 need to be used. So the exhibit 1 here, it says it's about a stadium. Stadium provides information about the sale and leaseback of this company's stadium, improvements made to that stadium, right? It's about stadium leaseback transactions and some improvements that's made to that stadium. So this Leria company is an internationally successful football club, and this company is preparing its financial statements for the year ended 31st October 2015. So we are currently in 31st October 2015, right? Currently year end is 31st October 2015, but it's currently facing liquidity problems. So they have mentioned few points, but the first requirement for us, this information should be used to answer the questions requirements, right, within your chosen response options, right? So we've been given the first part. First part is what? Whether the directors can classify the stadium. That means we need to refer to note 1, the exhibit 1. Referring to the exhibit 1, we've been asked whether the directors can classify the stadium as held for sale at 31st October 2015. That means on this reporting date, can these directors can they declare, can they classify this stadium as a non-current asset held for sale, right? So we know now it is the IFRS 5 which is being tested, and under the IFRS 5 there are two sections there. One deals with the non-current asset held for sale, where that we have no intention of using that asset in our business. That means we're not gonna make that carrying amount that appears on the balance sheet by simply make use of we're gonna is not that we're gonna make that assets use that asset, sorry, it's not that we're gonna use that asset in our business, right? So but on the other hand, our intention is that we want to sell that machines within 1 year period, right? So those are the conditions, just briefly. But the more importantly, that carrying amount that we declare on the balance sheet, we by declaring it as a non-current asset held for sale, the intention is that we're going to recover that carrying amount simply by selling it within 1 year. We're not going to use it in the business. That's the basic from this. So as I said to you, once we identify which standards that need to be applied, relevant standard has been identified, we just need to make sure first, it's going to be simple, straightforward. You just need to follow a sort of a discipline. You have studied, memorized the descriptions or the definitions or the brief rules about the relevant standards. That's going to be your first part, right? That's going to be your first part of the answer. So basically, like I said to you before we read the second part of this question, right? The answers or the exhibit. Let me move this here, right? So the first, what I would do as my first step here, I would simply define, right, or basic definitions of the standard that is related. So it's about the standards, about its principles or rules or conditions need to be defined, right? Briefly, as your answer. That's the first step that you would do, right? This is just for guidance here, step 1, but then you would not write in the exam step 1. You just need to make sure that you write the subheadings. Make sure that you can you highlight the subheadings. These are professional skills marks, and then you can even write the company name within brackets. Then the marker would know which company that you're dealing with, right? So then it's just need to simply write the we are dealing with non-current assets. So what are non-current assets means, right? So we know when we have an asset in our business, by declaring an asset on the business, the intention is that I'll think I have I make use of the IFRS 5 if anyone has missed it. So I think this is the IFRS 5 notes. Right, see here when I explain this, if the non-current assets means what? Fixed, right? If I have it here on the balance sheet, non-current assets, if I have it on the balance sheet under the non-current assets, if I have a machinery or any other assets, the stadium, say this in the example goes stadium. If I have a stadium under non-current assets, by showing it under the balance sheet, by declaring the carrying amount or presenting the carrying amount under the non-current assets, simply my message is this: I would be using this assets in my business, right? That means I would be using them in my operations. By using it in operations, I intend to make operating profit. This is the simple message I give to the stakeholders or the users of the financial statements. So when I'm going to declare it as a non-current asset held for sale, basically I would move them from non-current assets to current assets, right? Current assets in the sense at the end of the current assets, I would declare them as non-current asset held for sale. That means I haven't sold it yet, but it is a non-current asset, yes, but I have a plan to sell it within the next 1 year. So what's gonna happen to that carrying amount of 5,000? I'm not gonna use this 5,000 in my business, right? I'm not gonna make use of this 5,000, and then to use that asset in my business. But the way that I'm gonna get these 5,000 pounds back by selling the assets and recovering that carrying amount. That's the intention of non-current asset held for sale. But there are some conditions there for such purposes. That is what is being clearly explained here. So these are your lecture notes. Once you studied, you can see now we've done the second questions now. You would simply write it quickly as possible. You would write the brief definition of what is a non-current asset and what are the conditions. There are two main conditions are there. One, asset must be immediately available for sale. Second point is what? The sale must be highly probable. What is highly probable? These are the conditions which are highly probable. That means the price that you fixed must reflect the market price. Then it is unlikely that you're going to withdraw from the plan. Then management must be fully committed to sell the asset within 1 year. Then there is an active program that you're looking seriously, you're looking someone to buy your asset. Then sales must take place within 1 year. So when we come to, I just had one more point here, right? The last point says it highlights the sales should take place within 1 year, right? The sales should take place within 1 year. But sometimes there are exceptions, specific exceptions to this rule, right? So if I just quickly go back again, no, it's here, right? So if you just read back, let me make it a little bit bigger, right? And if you just read this bit here within bracket, it says subject to limited specified exceptions. What does it mean? I'll give you an example. Say, for example, the company is committed to sell the asset within 1 year, right? Everything committed, management is ready, actively looking for a buyer. But if the government is, if the company has to seek approval from the government to sell the assets, once everything is ready, government has to approve for us to sell the assets. In that case, if there is any delay that due to that approval from the government side, then the company has done nothing wrong. It is beyond the events that that cause the delay for the sales is beyond the company's control. So those are specific exceptions available for the company. That means they may take more than 12 months, provided the events that took place that delayed the sale those events are such that they are beyond the company's control, right? Example would be that seeking government approval, right? That would be one of the examples, right? So like we have just done it. So now we move on further. Now, as I said to you, now let's read the question paragraph. I've briefly explained about what is non-current assets, what are its conditions are. Now let's read this exhibit, right? Then let's read this exhibit and sorry, am I at the wrong think I'm at the wrong page, isn't it? I'm at the question 42 should be, right? So I should be here, right? So, but the first definition is the same, like I've explained in the earlier. We just, if you have a one sort of principle, is much easier, right? I mean, sort of a discipline, it's much easier. Why? You know that you're going to write what you memorize. You do not have to change the way of writing by simply looking at the marking script. These marking scripts may be written by different examiners at each exam sitting. So you do not have to change your approach. Have one set. When you start a standard, you're going to briefly define what you learn. That's the first step, right? So whatever the questions IFRS 5, your first step going to be same answer. No? So it's much easier if you have that kind of preparations. So the now second is where that we need to apply the standard, right? So when you apply the standard, we just need to read the question requirement. I'll be quick here. So it says Leria company has entered into a contract regarding its stadium. So we've been asked whether the stadium could be declared as a non-current asset held for sale. So what are the conditions we'll be looking for? It must be ready for immediate sale now. The stadium must be ready for immediate sale. It has not been sold yet, but it must be ready for the immediate sale. Um, immediate sale. That means you're not going to do any repairs. It is ready now for immediate sale. That's number one. Second condition is what? Sale must take place within 12 months, within 1 year. But as I said to you, there are specified exceptions. Specific exceptions are there, but that exceptions, the events should be beyond the company's control, right? Example would be the government. So let's see this. Now it enters into contract regarding a stadium where it will sell the stadium on 30th of November 2016, right? So let me highlight the sale date. They planned this planned sale date, expected sale date. Right? They have given us the expected sale date has 30th of November 2016. That's first, right? This is the expected sale date, which they have told us. And if I read further, it says, and immediately they're gonna get the assets leased back. Leasing, lease covered under IFRS 16. Lease is not under IFRS 5. It is outside the scope of IFRS 5, right? So the directors of Lira company wishes to classify the stadium as non-current asset held for sale. Now, this was the question. The question was what? We've been asked whether the directors can classify this as held for sale. So now they're saying directors wish to classify as an held for sale in its financial statements for the year ended 31st October 2015. Now things are much clearer for us, right? Now we've been given the classified date, non-current asset held for sale, non-current asset held for sale, classifying date. Classification date was they have given when they're gonna classify this. On what date they said? On the year end date, 31st of October 2015, right? That's the date they're going to classify this asset. They're going to classify this asset on that day. So, and they believe a sale is highly probable at that date, right? They believe the sales is highly probable on this day. The sale is highly probable, and that's right. So we know the first condition we're looking for whether it is immediately available for a sale. Then 12 months. So, and then the sale contract requires the disposal of the stadium for its fair value of 30 million. And now they're pointing out, what they're trying to point out by further points here. They said highly probable. When it's highly probable, we know it should reflect the market values. And the sale contract requires the disposal of the stadium for 30 million, which is the market value. So they had the market value, which is what we wanted. The first conditions under the under that highly probable sale is that the it should reflect price should be reflect the market value. and then for Lira company to lease back over after 10 years. We've not bothered about leasing back at this moment. The present value of the lease payment and the market rate. So that the second point here, it was given for if we have to discuss anything on lease. Market value for the stadium of this type has not changed in several years and is unlikely to change in the near future. So stadium being depreciated fine. So, and they're using reduced balancing method. That's fine. So, but referring back to the questions, reminding the questions again for us, the question is what? Can we apply IFRS 5? That's what the question is. That means to apply the IFRS 5, the asset must be immediately available for sale. So probably because they're saying sale is highly probable, the sale is highly probable at the date of 30th of October 2015. And this was the date where they would declare, right? They're saying the sale is highly probable, right? They're saying the sale is highly probable on this date, highly probable. So because they're pointing out sale is highly probable, then we may argue in favor, saying that it is the point of saying that the sale is highly probable. That means the condition one has been satisfied, and it is a highly probable sale, right? But then when we use this word, to be honest, we can't do this, because one of the conditions to point out highly probable is 12 months, isn't it? So let me change this in a way. So we know it must be immediately available for sale. Rather than using this here, we should say the sale is immediately available for sale. That's the right word, right? It is immediately. So immediately available for sale is where it is available on 31st of October 2015. That's what they said, isn't it? They said the asset is available for sale on that day. Say they said that it is a very year-end, right? And then as they believe the sale is highly probable, so on that day, so we believe that the sale would take place. There, it is ready. Asset is ready to be sold on 31st of October 2015 without any at its present conditions, without anything. But then the second condition, the main point here is that it has to be 12 months. And so the expected sale here, they said the machine, the stadium is ready to be sold only on 30th of October 2016. That's what they pointed out here, right? It is ready to be sold on 30th of, sorry, it is ready to be sold on 30th of November 2016, right? That's the date it is ready to be sold. Then we know for us to apply IFRS 15, IFRS 5, right? For IFRS 5 to apply, the sale should take place within 1 year, right? So within 1 year, in the sense here, it's what going to be the next period. Had I started from 1st January, like see how it works is if I start from 1st January, right? I started from 1st January, and then then the end date going to be what? 31st of December, 1 day before. So if I started from 31st of October classification, so the day before going to be the end date going to be 30th of October. All months will finish in 30th of October 2016. Now you can see. So this is the date within which the sale should take place, right? So this is the date within which the sale should take place. So now if we check the date here, right? From the day of classification, like on 31st of October 2015, if I classify on that date, it should have been ready for sale on, I should have a plan to sell this asset on or before of 30th of October 2016, right? Now you see the problem. But my plan here, when I say my plan is for for this Lira company, the company is ready to sell this stadium only on what date? The expected sale is only on 30th of November 2016, right? So 30th of November 2016 means it's beyond October. Then the 1 more month they have taken. They have taken 13 months to for the plan, right? They're expected to sell the stadium only 13 months. So with the sale, there is no plan to sell the asset within 12 months. Therefore, that condition, that the last condition here, the sale is expected to qualify for recognitions, and then within 1 year, this condition failed. Therefore, it is not highly probable, right? The second part here, it is not highly probable, like the directors are saying. To be highly probable, the last condition also need to be satisfied, that the sale is ready. It should take place within 1 year. So here, if they classify from on 31st of October 2015, it should take place within 12 months, within 1 year. That means 30th of October 2016. So it did not, they don't have a plan to sell it within 30th of October 2016. They got a plan to sell only 30th of November, one more month they're taking. They're taking more than 12 months. Therefore, it cannot be declared. Now, it cannot be classified as non-current asset held for sale because the conditions has not been met, right? So the first part now, the second part here, you must write them in your own words, right? That's how you would learn this. So when you write your own words, the points you need to cover, you need to clearly mention that sales must take place within 1 year. That's the condition. You highlight again the last condition, right? It must be immediately available for sale at present conditions, and then must take place within 1 year, right? And but in this, actually, the plan that they have is more than expected sale here. But the expected sale, they expected to be sold, expected to be sold after, right? So that's one. And then the second point is about lease. You would clearly point out lease is outside the scope of IFRS 5, and it would not apply to this case, right? So that's why. So the directors would not be able to classify. That's the first part. You would clearly explain. This is the second part. It's a simple two conditions for non-current asset held for sale. Now, if you look at these solutions, you do not have to memorize these solutions, right? The only you would memorize is what I've just said, the brief discussion, brief definitions, and then the conditions. That's it. And after that, the application is what is important, right? So here they have clearly pointed. Let me quickly show you how this has been, the answers being given. So the first part up to this point, right? So as I clearly pointed out here, and I think I need, but so here, so the first part, non-current asset held for sale, right? Non-current asset held for sale, discontinued operation addresses the accounting for assets which are classified as held for sale. IFRS 5 requires non-current assets to be classified as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through its continuing use. This is what we said, right? And that means we have no intention of using the assets, but we want to sell it and then recover the carrying amount within 1 year. So it must be available for immediate sale. That's the first condition in its present condition. And its sales must be highly probable within 12 months of classifying as a person. Now, up to this point here, it is simply the notes that you have memorized or you have studied, you would write it in the exam, right? That's the first paragraph that you would write. Simply state the rules or principles of that relevant standard. Second is where the exceptions which I've just highlighted, there are exceptions available. Like in this example, it took more than 12 months, right? But then it doesn't look like it is eligible for that exception because there is no other government involved, or they don't need any government approval to sell these stadium, right? And the events that are related to the delay was not discussed. They haven't told us those events are beyond the control of the company, Lira. So if that was the case, then we would consider. So here we have to point out, yes, in some cases there are specific exceptions there. If they take to more than 12 months, it will be still stays as a non-current asset held for sale. So the standard only foresees on an exceptions to this rule if sale is delayed by events or circumstances which are beyond the entity's control, like government approval is an example, which is unlikely to be the case in this instance. So we have just state the principle, and also we have highlighted the exceptions that is available, right? So there is a technical article that I have uploaded, right, which is a CPD article, and you would be able to find that. I would cover after covering all the IFRS 5 past papers. There will be a video on technical articles where there is an examples, right, very similar to this. And then now I'm going to state the rules. See, Leria company has entered into a firm sales commitment. We know there is a sale commitment, isn't it? That means it is available for immediate sale, but the sale will occur after the 12 months threshold, so that they don't have a plan to sell within 12 months. Therefore, stadium cannot be classified as held for sale, right? Additionally, you would point out that the sales and leaseback transaction is outside the scope of IFRS 5 and is covered under IFRS 16. That's it on this video. I will see you on my next video on this on IFRS 5. You take care.